All right, let's begin by giving you a sense of what's happening in the U.S. markets right now. Close to 2% down on the Dow Jones, 639 points down. Deep in the red, the Nasdaq also reeling about 1.5% down to 28 down. S&P 500 also in the red. So it's not just Wall Street that has had a bad day. Indian markets really felt the blues. Close to 8 lakh crore of investor wealth wiped off. The Nifty and Sensex both about 2% down, and perhaps a host of reasons, but Omicron and the uncertainty over Omicron definitely dominated. The continued exit of FIIs is also hurting, which is why Sensex shed over 1,100 points on the chin. The WHO's commentary over the weekend, which talked about the new variant doubling every 1.5 to 3 days in area with community transition and transmission, has also spooked markets. More and more data now coming out pointing to the fear of restrictions. Let me go across now to Sharad, my colleague, on what the key factors were.
Nifty has fallen below the levels of 16,100 on an intraday basis. Now, if we see the performances of today, the benchmark indices, Nifty and Sensex, they did shave off almost 2% in their values. And of course, Nifty Bank also saw pressure coming in at almost a downtick of 3.3%. If we see the index points falling from their lifetime highs, that's also startling, with Sensex falling 6,900 points and Nifty falling almost 2,100 points. However, Nifty Bank also saw a good shading of points, roughly coming in at more than 7,600 points. Even if we checked out the global indices, that's also where the pressure is there. You take Dow Jones, you take Nikkei, Hang Seng, most of these global indices are seeing a downtick of almost 1.1 to 2.5%. But what is the reason for the fall in the markets? The first one being Omicron cases, which are being prevalent, especially in US, and they are rising in the European markets. Apart from this, there might be an impending lockdown, which can be expected, seeing the current cases, and this can actually halt the economic recovery. Apart from this, US Fed would start its tapering process from the month of March onwards, which will impact the global market scenario. And of course, the central banks all over the world have started increasing the interest rates, especially Bank of England. And apart from this, FIs have been one of the main reasons for this sell-off. They have been sold almost 27,000 crores already in the month of December itself. Now we see which are the top losers, from the broader indices, and we have taken the date from October 19, where the highs were seen. And we can see for your broader markets, Valiant Organics, HEG, Balaji Amines, Graphite India, Tasty Bite Eatables, most of these broader indices are falling between almost 30% to almost 37 odd percent. Now those Nifty 50 stocks where they are near their 52-week low, that is your Bajaj Auto, your Hero MotoCorp and HDFC Life Insurance. Now if you see the broader indices, the Nifty 500 index, there is a clutch of stocks coming in for 52-week lows, especially Lupin, AstraZeneca and Coromandel in the thing, and of course LIC Housing Finance and Ujjivan Financial Bank. And over the last 2 months, from October 19 highs, there has been a serious erosion of market cap. So which are the top companies, having a highest erosion in market cap? That would definitely, to top it, would be Infosys, shaving off almost 7 lakh crore, followed by Infosys, Kotak Mahindra Bank, Bharti Airtel and HDFC Bank.
All right, Peter Cardillo and Ajay Bagga joining us on the show this evening to give us a context to what's happening in global markets and also in Indian markets. Can Indian markets continue to feel the pain through this week? Peter, let me start with you first. The situation seems to have, or at least fears about the situation seem to have dramatically deteriorated over the last couple of days. Is it all about Omicron?
I think it is at this point, but the problem is if this continues, the possibilities of lockdowns in Europe, I don't think it's a possibility here in the States, but certainly in certain countries of Europe, it's very possible. And that would mean slower global economic activity. As far as the U.S. is concerned, it's a very precarious situation because this will impact economic activity, and it's coming at a very bad time because it's coming at a time where we have a Fed that has changed its course and now has embarked on a inflation fight, and the inflation data is probably going to continue to stay relatively elevated. So the Fed is caught in a real bind here. It can't change its mind to fight inflation, since employment is pretty much at levels that we can say that it's the U.S. economy is at full employment, and so I think that's the real fear in the market. You have a Fed that's going to fight inflation, a virus that could very easily impact economic activity, and most likely many economists, including myself, are probably going to have to lower growth next year. So it's a bad combination, and I think that's what the market is really fearing here. And so we just have to wait and see over the next several weeks whether or not this acceleration of new cases begin to reverse and move lower instead of moving higher.
At the crux of it seems to be the concern that a spike in the number of cases will lead to restrictions and will impact any kind of economic growth and movement, service, industry activity. Ajay Bagga, is that what we're seeing reflected in Indian markets as well? Even though the data from India so far is not showing a huge explosion of cases, where we were on our daily new case load. The number of Omicron cases have increased, but no real reports of any kind of panic. Are Indian markets accounting for what we're seeing now in Europe and in the United States in terms of the Omicron?
Yeah, absolutely, Tamanna. It's a function of 3-4 major factors. One is, of course, the Omicron and the surging infections in the UK, Europe. So that is causing some sentimental dent. Second is the change in policy of central banks from accommodative to tightening. So you're removing the monetary stimulus when the economies might be in a shutdown mode. And the third big thing that really impacted sentiment today was the Biden package, the Build Better package of $2 trillion coming under a question mark because Senator Manchin said that he would not be voting in favor of the package. And so the Democrats don't have the requisite numbers to get the package cleared in the Senate in the form it is right now. That dented sentiments a lot today, because just when monetary stimulus is being tightened and removed, hopes of a fiscal stimulus also get dented to some extent. That was the big factor. Add to that it's the holiday season, volumes were low, and as the markets gapped down, you saw the herding in with stop losses being triggered at every point, and you saw the markets going down 2 to 3% across the countries. So function of the timing, function of seasonality, function of the central banks, the virus, and finally the US big package, which was expected probably under threat. I think these were all the factors. In India, we have the added discomfort of continued FI outflows. So if you see January to date, about 58,000 crores of net outflows. If you see April to date, about 108,000 crores of net outflows from the secondary markets that we've seen. That is what's really impacting the markets today. Also, if you see, FI sold 3,500 odd crores, and the mutual funds and insurance companies picked up 2,800 crores of that. But if you see the nature of the selling, why did your bank Nifty fall 3%? I would think that of the gross sales, a lot of it was the banking stocks, which were not picked up by the mutual funds. So heavier selling in the banking stocks, and that's why your bank index is down 17%. from its October high. They are facing a big brunt of it because they were overowned by the FIs as well. So India suffering with the global sentiments. We are linked into the globe because of the capital flows. Even though we have done a fairly good job post the second wave so far in
Yeah.
containing the numbers, but the uncertainty is what's roiling the markets.
So uncertainty on one hand, on the other hand, Mr. Bagga, follow-up question for you. Also this question and this narrative coming in that the correction was due. This may have come as a reason for the correction, but markets have run up phenomenally over the last 1 year. A little cooling off perhaps was required. What would be your advice to investors right now?
Yeah, correction was due. We had outperformed and valuations weren't cheap. Now, at 10 or to 15% down, valuations are good. As you were showing in the graphic earlier, quite a few companies are 30-40% off. You look at quite a few IPO companies, the profitless new age companies, those are at 25-30% discounts to their listing gains. So clearly, it's a cheaper market. What should investors do? I would say threefold. If today you have a big load on your heart, you're not able to sleep, then you're over-invested, then reduce your exposure tomorrow. If it caused you worry, but it's as per your allocations, then stay invested. There's no bottom fishing for now because we don't know where is the bottom. It will take time for this market to consolidate and find its level. We don't know how the variant will behave, how far the lockdowns will go. The good news, Tamanna, is the Moderna news today, saying that the third dose is increasing antibodies by 37 times. So if we get some more good news like this, like the Pfizer medicine is working on the variant, if we get 2-3 more things like that, that could change sentiment. If the Biden plan gets reduced to $1 trillion or something which is acceptable to the dissenting senator, that could change sentiments. And the third big thing is what will lead to the bottom formation when the sellers are done. I think right now there is still very active selling and it's a question of demand and supply. We are seeing selling at every rise right now. So the texture of the market has changed. We'll have to wait this out and see through January what happens with the variant spread. Moment you see something changing, market will front-end it and move much in advance of that information. So right now, cautiously poised markets, not the time to bottom fish. Yeah. I think it's best to go on holidays and let these 15 days go by. Yeah. Then we'll see again in January with the new allocations coming in where the market is intending to go.
Good advice there. Go on holidays, decide depending on how well you sleep at night with your current investments. Peter, are you seeing the pain continuing over the next few days, or are you hoping for a Santa Claus rally in the last week of this year?
Well, there's another negative factor here, which I forgot to mention, and that is we also have tax selling. There are many, about a third of the listings on the various exchanges are at 52-week lows. And so that means people are taking their losses against their profits. So that could continue. And that could be another factor for the market to continue to move a bit lower. Do I expect this I don't want to call it a correction, but do I expect this pullback to continue? No, because I believe that with all the therapeutic medicine that's out there, and with most of the people being vaccinated, the chances of a lockdown here in the United States is minimal. And in fact, look, the administration has made that very clear. So could we go back to maybe working from remote places? Obviously, but I don't think that will have a major impact as far as the economy is concerned. Now, that doesn't mean we can see a weakening, but certainly I don't think we're headed for anything like we were headed when the COVID-19 first came about.
And it shouldn't be. It shouldn't be. If we're going to behave or respond the exact same way nearly 2 years later, then what have we learned? Have we found a way to beat it or not? That is going to be the question that is asked. Thank you so much, Peter and Ajay, for joining us on the first discussion this evening.